I just invested 70% of the cash in my checking account into these three major dividend growth companies. First one on the list is Lowe's. I've been wanting to put some money into this stock for a while now, but I was just finally able to grab my first couple of shares. If you've watched some of my videos, you've probably heard me talk about Lowe's, and I've already done a full deep dive into the company in a previous video, so I'll link that in the description. But real quick, I like this company because, well, they make consistent money, so they're not going out of business, which is key. They're a dividend king, they have a very high dividend CAGR, and they have a low cash flow payout ratio, which basically means they can afford their dividend. And aside from all that, from a technical analysis perspective, they're at a substantial discount right now. So again, I'm not going to go too deep into Lowe's because I've already made a video about it, but I was finally able to purchase some shares and I wanted to just let you guys know. Now, I know I didn't talk too much about Lowe's, but these next two I'm going to dive a bit deeper, with the first one being Costco. Now, I've been hesitant on buying Costco because I'll be honest, I kind of missed a dip on them. And they're $1,000 a share, so I can't really buy much else if I'm gonna buy a share of them. But here's what I like about Costco. Their cash is up right now. Their net income was 1.79 billion in the most recent quarter, and it was up about 2.58% year over year. Earnings per share is also up at about 2.5% year over year, and they happen to be sitting on a little over $13 billion of cash right now, which they can use to help navigate through this whole tariff thing if it pops back up again. Now, there are some metrics that I'm not a big fan of at the moment, specifically their margins being down about 5% year over year, but I'm sure the tariffs played a big role in that, and I believe a large part of that is behind us. They did take on a lot of debt in 2020, but they have been consistently paying back their debt since then, with their total debt in the most recent quarter being down 1.8% year over year. They also spend money on share buybacks, and in the most recent quarter, they spent $205 million on share buybacks, which is up about 28% year over year, which is just insane. But at the end of the day, all the company needs is to be making more money than they're spending. And their financials reflect that, despite maybe not being out of this world. But moving on from their financials, let's take a look at their dividends. Right now, their dividend yield is 0.5%, but I'm not worried about their starting yield. I'm worried about their dividend growth. Their 10-year dividend CAGR, which just stands for compound annual growth rate, is about 10.1%, which outpaces inflation, and that's exactly what I like to see. Their 3 and their 5-year dividend CAGR are actually even higher than that by a few percent. And if you look at their chart over the past couple of years, the movement to the upside has been pretty explosive. So I can totally see them being able to sustain these 12 to 13% dividend growth numbers. But one of my absolute favorite things about their dividend is the fact that they only have a cash flow payout ratio of 17%, which is extremely low. That basically means that for every $100 that the company makes in free cash flow, they only spend $17 paying out all of their dividends. And then they have $83 to spend on the rest of the business. Costco has been paying dividends for 20 years, meaning they're very, very close to becoming a dividend aristocrat. And I don't think they're going to throw away that prestige, especially when their dividends are so cheap to maintain. I will say I did miss most of the dip on them, sadly, but it's down around 6.5% from its highs. So at the very least, we're not at the absolute top, but honestly, I'd probably be willing to buy there anyway. If you look at their chart, their growth is insane. Since 1995, they're up over like 14,000%. And over the past 10 years, they're up over, I think it's somewhere around 500%. I can't exactly remember. I don't have the chart in front of me right now, but explosive, explosive growth by this company. The last stock I bought today is also at the top of the dividend growth pyramid, a concept I touched on in the last video, but that stock is MasterCard. Now, originally I wanted to buy Visa, and I will someday, especially since Visa owns 50% of the market share. Uh, that's, I mean, not only is that an insane number, but it's like double MasterCard's market share. Honestly, I kind of want to buy just because of that. But right now, MasterCard's financials just look better to me. Their net income in the most recent quarter was 3.2 billion and it was up 8.9% year over year. Despite the whole tariff situation, they've managed to grow year over year for the past 5 quarters straight. So tariffs didn't even touch them. Their earnings per share is up 11.4%. Their operating income is up 15.1%. Really, it's just green across the board if you look at their most recent earnings. I will say they do have a lot of debt and their margins are down 4.6% year over year, but I'm really not too worried about either of those. Debt is definitely important, but a company can have a lot of debt and still be a good choice. As for their margins, again, I believe that was mostly due to tariffs. Aside from that, I was blown away by some of their other stats, so I was comfortable with looking past those two. I know this is basically all I do, but I watched a slightly outdated dividendology video to help me research this company, and I found just completely amazing stats when I looked at their free cash flow per share and their return on invested capital, both of which are some of the strongest statistics to look at when it comes to dividend growth investing. But MasterCard's free cash flow per share has been consistently growing for the past 10 years. And if you look at Seeking Alpha, from 2023 to 2024, it jumped a whopping $3 per share. I know that may not sound like a lot, and some people don't really have a frame of reference for this, but just to give you an idea of how big that is, their free cash flow per share in December 2021 was $8.75. December 2022, it went up to 10.43. December 2023, it went up to 11.54. From December 2023 to December 2024, it went up to 14.69. That growth was double 2021 to 2022 and almost triple 2022 to 2023. The reason why this metric is so powerful is because it is a direct indicator of a company's ability to pay out dividends. If they aren't making free cash flow, they can't pay money out. And if their free cash flow isn't growing, they can't grow their dividends. But that brings me to one of my favorite metrics, return on invested capital, or ROIC. Now, I really don't have an easy way of calculating it, which is one of the reasons why I enjoy watching Dividendology's videos so much. But because of that, I only have their ROIC stats from 2013 to 2023. But ROIC basically means how efficiently a company is using its cash to generate profits. And it's a very good metric for judging if you're looking at a quality company. Anything above 10% is usually a good sign, and a lot of really great companies can see 20% plus, uh, even consistently over multiple years. But from 2013 to 2023, just try to guess what they were at. MasterCard averaged about 40% return on invested capital. I literally have not seen another company with numbers near that high. Now, their financials look pretty solid, and those two metrics I value very, very heavily, and they're looking amazing. Let's move on to the dividends. If we look at their dividends, they have a yield of 0.5% and a 10-year dividend CAGR of 18%, which is incredible and heavily outpaces inflation. They've been paying dividends for 18 years and growing dividends for 13. And I know that's not a super long time, but honestly, it's good enough for me. And with a cash flow payout ratio of about 17%, I don't see that stopping or slowing anytime soon. If you remember from Costco, that's an amazing payout ratio to be around. I will say I also missed the dip on this because I don't have infinite money, and now it's only down around 4% from its highs, but still, that's technically a sale. Regardless of that, I'm willing to pay extra just because I just want to be in this company. But what helps with my bull thesis is that everyone seems to be expecting some rate cuts this year. If you don't know what that means, basically when interest rates get cut lower, borrowing is cheaper, which in turn will stimulate our businesses and economy because more people will be borrowing and spending money. More people spending means companies like MasterCard and Visa will be making more money. With that being said, I'm pretty much done with this video. I've been super excited to make it. I've been super excited to get into these companies. But especially after my most recent video, oh my goodness, I'm in love. I'm in love with making videos. I've had so many people comment and talk to me, and so many people being appreciative, like saying they learned stuff, things like that. Man, it feels so good. Thank you guys so much for commenting. Leave more on this if you want to. I really, really enjoy interacting with y'all, and it truly makes my day.